Imagine a city built for 1 million people. Roads, malls, apartment towers, schools, hospitals, everything ready, except one thing. The people never came. This is not a dystopian movie. This is China, and there are hundreds of these cities. But here's the part nobody talks about. Those empty towers were not a mistake. They were the plan. For 30 years, China ran the greatest economic growth story in human history. Hundreds of millions lifted out of poverty, factories humming, cities rising, GDP numbers that made Western economists nervous. And at the center of it all was one engine: real estate. Not technology, not manufacturing, not exports, property. At its peak, real estate and everything connected to it accounted for nearly 30% of China's entire economy. Think about that. Nearly 1 in 3 yuan spent in China touched the property sector in some way. In America, that number is around 15%. In most developed countries, somewhere between 10 and 20. China was double that, and nobody thought to ask what happens if it stops. To understand how this happened, you need to understand one thing about Chinese culture. Property is not just an investment, it is status, it is safety, it is proof that you made it. For decades, Chinese families saved aggressively and poured that money into apartments, not to live in them necessarily, to own them. Because in China, property prices only ever went one direction: up. Developers figured this out fast. If people will buy anything with 4 walls and a roof, build more, build faster, build bigger. Companies like Evergrande did not just build housing, they built an empire on borrowed money. At its peak, Evergrande had over 1,300 projects across 280 cities. It owed more than $300 billion to banks, suppliers, investors, and ordinary homebuyers who had paid in full for apartments that did not yet exist. $300 billion. That's larger than the GDP of most countries on Earth. And Evergrande was not alone. Country Garden, Sunac, Kaisa. One by one, the dominoes started wobbling. Here's the mechanism that made this possible and what makes it so dangerous. In China, home buyers pay for apartments before they're built. You sign the contract, you hand over your life savings, and then you wait. Sometimes 2 years, sometimes 5, sometimes forever. Developers use that pre-sale cash not to build your apartment, but to buy more land, start more projects, and fund their next round of borrowing. It was essentially a Ponzi structure wearing a hard hat. As long as prices kept rising and new buyers kept coming, the machine kept running. The moment it slowed down, everything upstream collapsed. In 2021, the Chinese government did something that seemed reasonable at the time. They introduced what they called the 3 red lines policy, a set of debt limits designed to cool down over-leveraged developers. Borrow too much, and you lose access to new financing. It was supposed to be a soft landing. Instead, it pulled the brake on a vehicle doing 200 kilometers an hour. Evergrande defaulted, then others followed. Construction halted on millions of units across the country, and those home buyers who had already paid, they were left waiting, angry, desperate. In 2022, something remarkable happened. Groups of home buyers across dozens of cities coordinated a mortgage strike. They simply stopped paying their loans, not because they couldn't afford to, because they refused to pay for apartments that were never going to be finished. At one point, mortgage boycotts spread to over 300 projects in more than 90 cities. Banks got nervous. Local governments got nervous. Beijing got very, very quiet. Now here's where it gets uncomfortable. The Chinese property crash is not just a story about greedy developers and reckless debt. It goes deeper than that. Local governments in China are heavily dependent on land sales for revenue. In some provinces, land sales account for more than 40% of local government income. When property markets freeze, local governments run out of money.
When local governments run out of money, public services slow down, infrastructure projects stall, and social stability, the thing Beijing fears most, comes under pressure. There's also the wealth effect. Roughly 70% of Chinese household wealth is tied up in property, not stocks, not savings accounts, property. When property values fall, Chinese families don't just feel poor, they are poor. And when families feel poor, they spend less. And when 1.4 billion people spend less, the global economy notices. This is already happening. Chinese consumer spending has been weak. Youth unemployment hit record highs. Deflationary pressure, the exact opposite of what the West has been dealing with, is creeping through the Chinese economy. The government has tried stimulus, rate cuts, relaxed purchase restrictions, rescue funds for developers. But here's the problem. You can't easily fix a confidence crisis with a policy announcement. When people believe prices will keep falling, they wait. And when they wait, prices keep falling. It becomes self-fulfilling. Zoom out for a moment. China is the second largest economy on the planet. It's the world's largest consumer of steel, copper, cement, and countless other commodities. Countries like Australia, Brazil, and much of Southeast Asia built their own economic growth on China's insatiable appetite for raw materials. A prolonged Chinese property slump doesn't stay inside China, it ripples. Commodity exporters slow down, shipping volumes drop, supply chains restructure. The countries that spent a decade betting on Chinese growth suddenly find themselves holding a bet that has changed. And there's one more layer that rarely gets discussed: China's demographic problem. The population is shrinking. The number of young people who would typically be entering the housing market, forming families, buying apartments, is declining. Demand for new housing was always going to fall eventually. The crash didn't cause that. It just arrived earlier and harder than anyone officially admitted. As of today, hundreds of millions of square meters of unfinished housing remain frozen across China. Some analysts estimate the overhang of unsold and unfinished property could take a decade to work through. Others think that's optimistic. The Chinese government is not going to let this become a Lehman Brothers moment. They have the tools and the will to prevent an outright financial collapse. But preventing collapse is not the same as recovering. Japan tried to manage its own property bubble collapse in the 1990s carefully and quietly. They called the following period the lost decade. It lasted 2. So here's the question worth sitting with. If the world's largest growth engine runs cold and hundreds of millions of Chinese families watch their primary store of wealth erode year after year, what does that do to the global economy that spent 30 years building itself around Chinese demand? We don't know yet. And that, more than any single default or frozen construction site, is the scariest part.